Welcome along to day 4 of BTL Blueprint Week, powered by Nova Financial, and joining me all this week has been my guest and co-host, MD and founder Paul Mahoney. And for this instalment, Paul, we're going to touch on a topic that's actually very, very important to my heart, and it's actually chapter 5 in your book, the Property Pension Plan. Chapter 5 is dedicated to this entire topic, and it's really interesting because everybody, I think, has their own little kind of due diligence regime or little template that they use, and you've actually got 10 pointers, and those are really kind of 10 boxes that any property deal that you're going to consider investing in, it has to tick those boxes.
Yeah, so essentially just the 10 different factors to consider when considering a particular area and property itself. So should we go through them?
Yeah, we've got 10 to get through. So number 1 is supply.
Yeah. So obviously any investment is determined by supply versus demand. And the ideal scenario is that we have a current lack of supply, but also a future lack of supply. So meaning that currently there's not enough properties there, but there's also a lack of ability for lots more to be put there and a lack of reason for them to be put there, if that makes sense.
Very good point.
Because, you can buy in an area that is currently undersupplied, but if they build 50,000 properties over the next few years, then that could become oversupplied. So in my opinion, a good way of doing this is buying in a location where land is very limited. So generally that happens in central locations. And the other side to that, which I think is point 2, is these are areas where there's very strong demand, because there's strong reasons for people to want or have to live there. Things like jobs, facilities, amenities.
I would actually put demand at number 1, because I think, we hear a lot of this term, buy below market value, BMV. I do like to point out that is a tactic. It's not a strategy. And you could buy a property BMV, but, you could get the most fantastic deal in the world. But if nobody wants to rent it, it's actually not a deal at all. You've lumbered yourself with a liability. Yep. So I absolutely agree with you that you've got to ascertain tenant demand. And a very simple way to do that is to phone around local estate agents and ask their opinion. They know their area.
Yeah, absolutely. I'd say each of these points are just as important as each other. Yeah. They're not necessarily itemised in order of importance. Just one point on that, because I half agree with you so far as speaking with estate agents, because I know that some do know their area. However, I've spoken with some estate agents who know very little. So just be a little bit careful with that. Because, you can be a concreter one day and an estate agent the next. So there aren't any qualifications to become an estate agent. So make sure you are actually speaking with somebody who does know their area. Yes. And of course, it's probably pretty easy to ascertain that. But I've definitely spoken with some estate agents and some clients who've spoken with estate agents who have just assumed that person knows everything about the location they're in, whereas in some cases they definitely have not.
Well, we all know what assumption happens when you make assumptions. On that note, you do definitely want to work with an agent who has committed voluntarily to professional standards. So you should be looking for an ALA or safe agent or RICS registered agent, just as a little side there. So moving on to number 3, target market.
Yeah, so understanding who your target market is and what they want. So we touched on this in a previous episode. Firstly, if you're looking at a particular location, I'd say let that determine what the right target market is. So, for example, if you're targeting young professionals, then quite often they'll want to live in flats or one or 2 bedroom apartments. If you're looking at a family type tenant, then probably looking at 3 bedroom houses. So you want to make sure that you understand who they are, what they want, the demographics of them. So, what are their average incomes, employment rates, vacancy rates, all those types of things, the demographics of the area, and then make sure they are skewed in your favour. Where some people can go wrong is they'll buy the 1 bedroom flat in the family area because it might be cheaper. But even if it's a great area, if there's no demand for 1 bedroom flats in that area, well, your property's not going to do very well, and vice versa, the house in the flat area. So you want to make sure that demand, understanding your target market is important, but that will help you understand how the demand is skewed in your favour.
And also, I think understanding your target market is also going to determine how you set the property up and so on as well. So that is important. Well, number 4 is location, or as Kirsty and Phil like to say, location, location, location.
Yeah.
And of course, absolutely vital. I personally think that the number one thing really is access to major transport links, whether that be bus, train, motorways. People need to be able to get around.
Yeah. Yeah, so I think that's the 5th point, infrastructure, which definitely ties into location. But, understanding the particular location itself ties into the previous point as well. Who's your target market there? What's the best target market there? Where is it skewed? What's happening in that particular location? As I mentioned before, my preference is central locations, because that's where you tend to have the most depth in factors, such as demand, but also infrastructure, amenities, facilities, all those sorts of things. Reasons, really strong reasons for people to want or have to live there.
Yeah. For central locations, I have what I call the pint of milk rule. Okay. So our properties in London, one of the criteria for them was that each apartment had to be within a 5-minute walk of a pint of milk.
Okay.
Because that's what people want, isn't it?
Yeah, absolutely. Yeah. And I think understanding that the shift in generational preferences is very important as well, because I without a doubt, and there's many reports on this quite recently over recent years that show that your younger generations do want everything on their doorstep. Mm-hmm. There's a strong trend toward the repopulation of city areas. We spoke about Manchester before. That's a really great example. If you look back 20 years in Manchester, there was only 1,000 people living in the city centre, because it was mostly retail and commercial space, and everyone lived out in the towns and they travelled in. There's now 30,000 people. So huge change there, with all this new residential property coming into central Manchester. And that's not just being driven by the people building the property, it's being driven by what the people living there want. Yeah. So having things like the infrastructure on your doorstep, jobs, bars, restaurants, cafes, that will ensure you get the demand from that type of tenant.
Yeah. So, Paul, I think, location does actually move on to your point number 5, which is infrastructure, because clearly, people do need transport links to get around. They need amenities, they need supermarkets, all the things around everyday living. But also, I think when you see infrastructure going into an area, that's a very, very good sign. For instance, a new tram line going in. We bought a property, a flat, where there was a new DLR station going in. That's had a massive impact on values in the area. So if you see that money is going into an area, that's actually a very positive sign from also a capital growth appreciation.
Yeah, without a doubt, and the DLR is a good example. The Crossrail is a perfect example. Infrastructure can really change the face of an area, and if you can get out ahead of that, it can have a huge impact on your property. Another good example, which there's been a bit of doubt in the media about recently, but HS2, that will have a huge impact, assuming it's done. On places like Birmingham, Manchester, Liverpool, improving the links to London. So yes, major infrastructure like roads and rail can have a huge impact. So it's always great to understand those. I think it's also important though to not get too far out ahead of them, in that you want to make sure they're actually happening.
Yes.
Don't speculate too far ahead of time. But if you can, I'd say probably if you can see it start to impact an area, it's probably likely to continue to impact that area. So, a bit of a test there to make sure it's actually going to happen.
Yeah, I think another thing interesting to look at is where you see big retail parks going in, because these giant corporates do so much due diligence. They're not going to invest in an area if they're not going to have any footfall. Yeah. You mentioned coffee shops as well, actually. The likes of, Costa and so on, they do a lot of research to see if there is the kind of target audience there. So you can often kind of piggyback off the signs that you see in the area where big companies have done their due diligence.
Yeah, there was a term in the media a few years ago called the Waitrose test. Yeah. Which
still going around, actually.
which is still being used, but that applies to all as you say, all the major retailers. They don't spend a lot of money in establishing themselves in an area without knowing that area is moving in the right direction.
Yeah, so it's a good thing to look at, actually. If we move on, your number 6 is actually price. Yeah. And of course, it's valuing a property. It's not scientific. It's got a lot of different nuances to it. Even surveyors struggle sometimes to value properties. So what's your version of price?
Yeah, so that's one of the key points that I mentioned there is surveyors do struggle. It's often determined by comparables, but if there are no close comparables, it's a bit of a guess. So you can't necessarily just rely on a surveyor, and I'd say especially not just rely on a bank surveyor, because they tend to be quite conservative. So we all want to pay the best price possible, or the lowest price possible, but it's not just about price either. I think that's where some people can go wrong, is just trying to buy cheap property, which is usually cheap for a reason, or it's always cheap for a reason, really, unless you're very, very lucky. So considering desirability is the other side of the equation, because that's what drives demand, unless, of course, you're a developer or something and you're going to completely change the asset. But if you're a passive investor, you need to balance price with desirability.
No, I like that. And actually, one way that I assess the value of a property is what actual level of borrowing the rent will support. So I just do a basic calculation. I will put the calculations actually below this video because, if it doesn't stack up financially, just to what level of borrowing the rent will support, then it's a clear indicator to me that it's probably not the right property.
Yeah, absolutely. And as we've already covered, the borrowings is a key part. That has a huge impact on the returns on your funds. So you need to make sure that works.
Quite easy to stack a deal just on paper there.
Absolutely.
Now you've got number 7, fair value.
Yeah. So this ties into what I mentioned about price. And the point here is not being afraid to pay fair value for a really good property. And again, I think is another bit of a pitfall that people fall into, is a really good property in a really good area is not going to go unnoticed. And that's usually a property that will perform quite well over the mid to long term. So I think some people won't buy something unless they can get a discount or feel like they're getting a deal. You mentioned BMV or below market value before. I would say 9 times out of 10 I see that term. It's being used as a sales tactic rather than a reality. The definition of value is what someone's willing to pay for it. So the BMV doesn't really make sense based upon that definition. Of course, you can get properties that are really well priced, and that's what we always want if we can get it. But don't be afraid to pay list price if you have to, if 20 other people want to buy it because it's a really good buy. Because in my experience, when comparing the properties where people think they got a deal to the properties where people have paid, but kind of begrudgingly paid fair value, it's the latter that performs better.
I'm so glad you said that, Paul, because one of my criteria is thinking about when I want to come and sell that property. You just said if you've got 20 other people competing to that property, you know that it's desirable to the owner-occupier. When I come to sell, I want to be able to go to the owner-occupier market and achieve the best possible price for when I'm exiting from my investments. I don't want to, somebody to come and see it and went, it's too close to that train line or something like that. I think you're absolutely right that longer term, it's better to as you say, go for fair value. And I think those sort of properties also, they survive a downturn a lot better as well.
Yeah, I agree. And that's another point that we sort of, really make sure our clients understand is not just buying what I call sort of investment stock. Not just buying properties that only make sense to landlords, but also making sure they're desirable to the owner-occupier side of the market, because that's a big side of the resale market in your exit strategy.
Absolutely. We're moving on to number 8, economic changes and legislation. Well, as we've been saying all this week and all the time on Property Tribes, actually none of us have a crystal ball. No. We can only work with what we actually know about, what's in statute, what's in legislation. You've got to apply that to any investment you're looking at. Yeah, absolutely.
We've had quite a lot of these lately, especially legislation. And potentially some economic changes upcoming, or a lot of people would think so anyway. So I suppose the thing here is making sure that you're protecting against the downside. So, if you're stress testing your portfolio and you're looking at, what happens if interest rates rise substantially? What happens if, I do struggle to remortgage or whatever that might be? Making sure you're testing those scenarios and making sure that your strategy or your portfolio still works.
So kind of future-proofing.
Absolutely.
I like that. We're at number 9 now, and you've got vendors. So explain what that means.
So it's essentially the person you're buying from.
Yeah.
So this isn't as relevant if you're buying second-hand property, but it becomes very relevant when you're buying new build or off-plan property. And we tend to like that type of property in the right circumstances because they're much more passive. I'd say most of our clients tend to be more hands-off type investors. They don't want to get involved in the nitty-gritty of, fixing properties and all those types of things. And properties that come with a range of warranties do that quite well.
Yes, I totally agree.
But you want to make sure that especially you're dealing with a developer, that they have a strong track record of delivering on their promises and good quality properties. We do a lot of due diligence on developers, what they've done in the past, their financials, making sure that their properties aren't falling down a few years later and all those sorts of things to make sure that we're comfortable and confident in dealing with them for ourselves and therefore, of course, for our clients. Yeah. So that becomes absolutely important when you're buying new or off-plan properties, even more with off-plan properties, and making sure the buying structures and the protections that are in place to make that as low risk as possible.
Well, again, Paul, this is all good stuff. And I think, just as an aside, when you complete on the property a new build, you must have it snagged.
Yeah.
We've had some properties where there were maybe 4 snags, and then we've had another one where there were 200 snags. Yeah. So again, you've got to protect your asset and do your snagging if you're buying new build.
Yeah, absolutely. And that's a service that we provide to our clients, actually. For those that don't want to, if they might have bought in Manchester or Liverpool or wherever and they don't want to go out there and do it themselves or pay another service they don't know to do it, we provide that service to our clients.
That's good to know. And so we're just on number 10 now, and that is type of property. We have touched on this briefly. Clearly, you've got the choice of flats, maisonettes, standard terraced houses, detached houses. How do you kind of do your due diligence on that?
Yeah. We tend to take the view of focusing on the benefits rather than the features. Okay. And what I mean by that is, especially when it comes to investing, and as we've discussed, it's about being commercially minded and sort of making money from your investments. We tend to look at it as, well, where's the best possible place to invest, the best location, with all the right driving factors, and narrowing that down to where we're comfortable and want to invest, and then allowing that to determine what the best property is for that location. So, as I said before, if we're focusing on very central locations in major cities, that tends to be flats. And some people will say, well, their leasehold, there's service charges, all of those things can still stack up and still make a lot of sense as an investment in the right circumstance. For example, the lease is substantially long or sufficiently long. For example, if the lease is over 150 years, it's very unlikely to cause you personally any issues because we're finite. The lease is probably going to outlive us. So that's important to understand. Understanding things like service charge and the costs and things that go into it as well. So long as we're comfortable and confident with the net outcome after being conservatively accounting for those things, then that can make sense. Yeah, of course, all the other types of properties can make sense as well. But I think a lot of people tend to come in tend to look at property with sort of preconceptions. For example, an old one which we still hear sometimes is the values in the land. And in my opinion, it's absolutely not. That the value is in what someone wants or needs. So you can have, you just got to look at central London. You've got 1-bedroom apartments worth 2 million. And that's because there's a lot of people that want to buy them and there's a finite number of them. And vice versa. You've got 10-bedroom castles in Scotland worth 50 grand, maybe, or around not much more than that. And that's because no one wants to live there. So it's about supply and demand and how much people want those properties. And going back to what I mentioned before, a lot of people are looking to live in central locations now. It's something that we call trading space for place. People don't necessarily want a massive property anymore. They're more, and people are having kids later. They're more than willing to live in their centrally located property for a lot longer than maybe people were 10 years ago. So I suppose the point here is being open-minded. Investing in the right properties in the right locations, regardless of what they are, based upon the right information.
No, I think open-minded, we should have actually added that into our video about mindset, because I think you're absolutely right. I think just a little tip from me on flats: if you're going for a 2-bed flat, I would always go for a 2-bed apartment that had equal-sized bedrooms and also had ensuite as well as bathroom, because then you open your market up to two kind of sharers, two single people, or maybe a couple with a small baby. I think just think about those kind of options when you're looking at properties. And you know, little things like, what can you see out of the window? Nick and I, we never forget it. We went and viewed a flat in London where it looked out over a bin store, and that was your view. Whereas there was a flat at the front of the property that had a much nicer view. So again, we go back to kind of walking through the property, walking around the area, looking at it through the eyes of the tenant.
Yeah, and I think that comes down to your due diligence as well. Things like the floor plans can make a big difference. And some cases in, you know, a block of flats, for example, you'll have one property that's a lot better than the next and might be a very similar price. But obviously the one that's a lot better is going to have more demand. So that ties into make the right choice, I suppose.
I think it does. And finally, I think we would say, Paul, and disagree with me if you feel that you want to, but I would never, ever buy an investment property without going to look at it. You've got to walk the streets. You've got to, walk the journey from the transport link to the property. You've got to make sure that you understand it from every angle. As you said before, it's the biggest investment you'll ever make.
So, you know, to be completely honest with you, I probably wouldn't either. But I think that says more about us as people than it does for everyone, because a lot of our clients do invest in properties that they've never seen, but they do that because they're comfortable and confident with what we've shown them and educated them on. And therefore they don't feel as though they necessarily need to, but others do. So I really think that comes down to what you feel you need to do to be comfortable.
Well, I think that sums up what being a property investor is all about. You can do it in whatever format works for you. But I think, you know, this has been very interesting, actually, Paul. Thank you for that. So these 10 points are in Chapter 5 of Paul's book, The Property Pension Plan. We'll put a link to the bottom where you can get a free copy just for the price of the postage, and it goes into a lot more depth in the chapter. So I'm sure that everybody's found that very useful, Paul. Thank you. Tomorrow, we're going into part 5 of our week, and we are going to be talking about 3 very important aspects of being a landlord and property investor, and that is tax, finance, and management of properties. So join us for the final instalment of Buy-to-Let Blueprint tomorrow.